Well, I think the Fed's been missing its opportunity for really this whole post-pandemic period. You know, we have a book at the Fed of $8.3 trillion worth of asset purchasing. There's been a slight extension of when rates will, with respect to their dot plot, be raised, which is now into 2023 instead of 2024. It's still a ways off. I think what should have happened and didn't, and yes, this is a missed opportunity, is that in the beginning, when things were in crisis mode, and this was missed during the last crisis, the financial crisis of 2008 as well, in the wake of that, there should have been more speak about, look, we're going to do this for a while. We're going to do this until we see, yes, some sort of stimulus in the economy, but not wait till it goes down the other side. But more than that, the stimulus has gone towards the markets relative to the economy this whole time anyway. And the Fed and other central banks have been very non-cognizant of that potential bubble that they have created yet again. So I do think what they're doing is missing that opportunity from the beginning. They should have learned from last time, and they didn't. But now there's a situation where if you take a move too quickly, the markets then get spooked out, and the whole sort of ramifications of that come into play. And the Fed looks at the market, and I continue to say this and write about this, as much, if not more so, than it looks at the economy, even though technically the market isn't one of its dual mandated particulars.
And I'm glad you've gone down that route, because I didn't want to do you out of future book sales, because this is what your future book is about: permanent distortion.
It is.
Which is so. Yeah. So look. So I mean, again, I just ask you the question more bluntly, perhaps: is policy now for the markets as opposed to for the real underlying economy because of those fears you just mentioned?
It is, and just whether that's a belief or if you look at the numbers, if we just look at what's happened, and the pandemic, of course, was something that was an exogenous factor. But what happened was the economy has sort of gone back to, if you look at the U.S. economy, the size that it was pre-pandemic, with stumbles along the way, obviously, and some ups as well. But the market, if you look at the NASDAQ, it's 50% higher than it was in February 2020. The Dow was 20% higher than it was in 2020 at its heights going into the pandemic. The economy is maybe about 4 or 5% higher, and that's only if you look at specific elements of it. If you look at the actual, day-to-day life, what people have to spend versus what they are making, what the real situation with jobs are and everything else, it's really not had that same sort of upswing. So there has been more of a divergence this time around relative to the last crisis of the markets relative to the real economy. The only difference is there's been a bit more government stimulus from governments around the world in the process than last time. And potentially that has actually given the economy a bit of a boost up. But the central bank policy has continued more so to flow into the markets around the world.